As a trader, we all heard the saying that 90% of traders lose money in the market. And it's not because trading is impossible, but because they overcomplicate everything and sometimes they lack discipline. In this video, I'm going to show you the simple steps I use when trading the futures market, because sometimes it just comes down to having a good strategy. So what's happening, my people? It's your boy Rome, and on this channel we keep trading simple and break down real strategies that everyday traders can use and that I personally myself use. Now I'm gonna give you 3 reasons why traders fail. Now there's 100, but a lot of people use too many indicators. They don't have good risk management and they lack patience, or they overtrade. So these are some of the things that people tend to go through, but there's other things like timing, not having a good strategy, not having discipline, and these are all things that if we want to be successful, we do have to work on, because this is a career. Alright, so like I said, I want to introduce my trading style. And when I trade, I like to keep things simple. I really focus on 3 things, right? So the first being structure, the second being key levels, or we call them areas of interest, and the third is going to be my entries, right? Now I want to go through a couple examples of what I look at when I'm trading in the market. The first thing I want to talk about is market structure. I'll go more in depth on everything that I talk about in this video, but right now I just want to give you a complete overview. So there's 3 type of conditions that a market is usually in. It's consolidation, range, or trending. Just as a quick overview, when I'm thinking of consolidation, this is something that looks like consolidation to me. Where I have this box at, this is where price is just moving sideways. It's not really making any movements higher or lower. It's not creating anything. As you see, it went up and it kind of created some more consolidation. We're just moving sideways. We don't really have an idea of where price is going. Here in this level, in this box, this is a trending market. We see prices going higher. We're taking out highs to the left over here. So we see price running higher, taking out highs to the left, and then we see price come back respecting this low that it created and continuing higher. So this is more of a trending market. All right. And then for the last one, for ranging markets, we have it right here. Price tends to operate inside of these cycles. So this is a ranging market. See, we have nice push down, nice push up. We create some equal highs. We have some pushes down. We come up, we sweep out the highs. We go lower. We're kind of moving sideways. And before we go higher, we sweep out the range low. All right, so this is more like a ranging market. So that's market structure. Next thing I want to talk about is the time frames I use. The time frames are very important for me. I start off on a daily time frame. So the first thing I do when I come to the market is I want to mark out the previous day high and low. If we're looking at it from this perspective, this is our previous day low, this is our previous day high, right? So this, I want to see the previous day low, the previous day high, and the midpoint. Why? Because these areas act as liquidity. They're areas where the market can react to and the market can respect and use it as support or use it as resistance. Another thing that I look at in the market is swing points, or 3 candlestick patterns. So you have a swing low and you have swing highs. So this would be an example of a swing low. We have this low right here. I call it the maximum low right there. We have a higher low to the right and a higher low to the left. This is a swing point. Often you'll see the market go and respect swing points. So over here, this is a swing point. We have the maximum low, and then to the left of it, we have a higher low. And then to the right of this candle here, we have higher low. That creates a swing low. And it's the same for a swing high. It's just inverted. And you'll see price respects these levels and uses them sometimes as either resistance or support. So in this case, we're going to use it as resistance, right? This is a swing high here. Why is it a swing high? Let's mark it out real quick. We have the maximum high in the middle. We have a lower high to the left, and we have a lower high to the right. This candle right here makes it our swing high. Price came up and touched it perfectly, and then you see it reverse. So that's swing points. That's one of my key levels that I look at. What I would like to do on a daily chart is just draw up that previous day high, low, and midpoint. All right. And we're going to take a look at yesterday's price action, and we're going to go over all the trades ideas that I seen today and the trades that I actually took. So what I like to do at the daily chart too is I want to draw up the relevant swing lows and swing highs that haven't been tapped into yet. So these are the swing high. This is the swing high that hasn't been tapped into, and this is the swing low that hasn't been tapped to. As you can see on the daily chart, we're moving in a ranging formation. We're moving sideways, but we're traveling some nice distances, which once we scale down to this lower time frame, it can be beneficial for us. So I start off with the daily time frame to get my key levels, my swing high, my swing lows, and my fair value gaps as well. I look at fair value gaps on the daily and also the midpoint. So on the 15 minute, this is where we start getting into my actual strategy. All right. So I use the daily, the 15 minute, and the 1 minute. I use the daily for those key levels and larger ideas and larger areas of interest that price could draw from or go to. For the 15-minute time frame is my structured time frame. It's where I want to see how price is reacting from certain key levels. Are we ranging? Are we trending? Do we have a supply? Do we have a fair value gap? Or do we have a swing point? Those are my three main key levels. There's a million of key levels that you could possibly have. My main three are swing highs. We have a swing high here. Fair value gaps. Let's just mark them out. We got this fair value gap. We have swing highs. We have swing lows. And we have supply and demand. And we do have some supply right here. This could be looked at as supply. This big black candle. We came down and we took out this swing low. So we broke structure to the downside. We came back up into this area, and then we fell. But we also have a fair value gap here. What takes precedence with me, for the most part, is going to be fair value gaps. I like to take fair value gap plays. And then I like sweeps. I like supply and demand too. So it just depends on what the market is showing and what it's giving. But when you have these fair value gaps, it's letting me know that price is having a lot of energy going into the direction that I want to see price go into. So now I want to break down a trade using all three key levels that I like to look at in the market. First one we're going to look at is a swing high used as resistance. All right, so we can see that the market is moving sideways here. Price is going from left to right. And then you can see price runs above that swing high to the left. And then we close back inside of the previous candle's body. I'm a price action trader. I pay attention mostly to the way these candles form. All right, so once I see this respect happen, what I want to do is go to the 1 minute chart. Now this is where I gain my entry. So I take order block entries, and just as a quick point, an order block is the series of up candles that took out a major level of liquidity or a key level, or went into an area of interest, or went into a key level. So here we ran into this 15-minute swing high. That's what this white line is. Price then melts down, and this series of candles right here, these series of up candles got closed through, meaning that this high right here shouldn't get taken out, right, if we're going to continue to go lower. And that is a simple order block. All right. So sometimes I like to wait for more confirmation, and I want to see a continuation order block. How do we get a continuation order block? We want to see price take out swing highs or tap into a fair value gap and then create another order block. All right. So in this case, I actually took this exact trade today, and you see that price created the continuation order block right here. If I scale in a little closer, you can see that price closed below this series of up candles, creating a continuation order block. And I took my entry right here. Now, This is a 52 point stop loss. And for my take profit ideas, what I like to do is go for a 1-to-1 first. And I usually take some profits at that 1-to-1 level. So when price got right here to this 200 EMA, I did close some of the position. And then I let price come to the next key level, which is right here, 1.9 Rs. So that is the first setup. There's a picture perfect setup for me. The next, we're going to go to the same day. All right. So what we can see happened here is price expanded lower, and then we created this fair value gap. So the second key level that I look at is fair value gaps. Once price taps into these key levels, that's when I want to go down to the 1 minute chart and start reading price and see if we can get a order block of some sort created. And I also took this trade as well this morning. All right, so in this case, you can see that price went up into the fair value gap right here. This was the first point. And then we had some expansion lower, but we didn't create the order block. All right, price ran up one more time, went higher. And as price went higher, we took out this high, right? And so there's a couple different ways. The safest way to play this right here would be to wait for price to close down here. Now, why I say that is because this is the actual leg that went and took out the high. But here you can see we created another, we created a series of down candles right here. These two white body candles. And then we had another run higher. And then we see price expand lower right here. So this is where I decided to take my trade. And like I said, you don't always got to wait for that extra confirmation. Like the first trade, I waited for the extra confirmation. And this one, I didn't, right? So this is the second example. Once again, we tapped into our 15-minute fair value gap. We created the order block. We closed through the order block. I take my entry right then and there, put my stop loss here. In this case, price came close to stopping me out before reversing back down and going and hitting that 1.9 Rs. Now the last trade I want to show you, the last breakdown, is going to be on gold. All right, and this is a supply setup. All right, so you see prices moving down lower. Now this gray line that you see here, it's going across. This is the previous day's low. So when you have something like this situation, you want to be real careful because, like I said, this is where liquidity could lie and price could reverse from this level, right? But this is still a valid supply, and I'll tell you why. So when I'm looking at supply, I want to see price take out a swing low in that candle that creates the supply. So this is the supply candle, the last up candle before the shift in price action. All right, so when price comes back into this area, I want to scale down to 1 minute. All right, now with this, you can see that it took a long time to play out because price actually tapped into that supply area right here. Now, if we wanted to create an order block, price would have to come all the way down here to this level and close below this low. All right, and you can see price didn't do that. All right, price kept continuing to move sideways. So what you can see though is prices still continue to make higher highs. So we put in a swing point right here and then we went higher. And here is where we finally got our shift that we are looking for. We got our order block creation. Why is this an order block? These series of up candles came, took out this swing high, and then we got aggressive closure below it. All right, right then and there. Once this candle closes, I'm looking for my entry. Now, I like to put my stop loss above this swing high. Like I said before, first take profit would be like a 1-to-1, which is a decent idea here because we're below these lows. And then I go for the 1.9 R, right? And you see that price did go down there and hit that low. So those are the three simple strategies I like to use. The key levels are supply and demand, swing highs and swing lows, and fair value gaps. And then my entry is always the same. I scale down to 1 minute time frame. I look for order block creation. I enter in on the closure of the confirmation of the order block. I don't usually wait for price to come back and retest the order block. I enter in once we close below it, and I put my stop loss above the swing highs that created the order block, or the swing highs of the order block. I go for a 1-to-1, and then I leave a running for my 1.9 Rs. That's all. If you're trying to learn trading without all the complicated stuff, make sure you subscribe here, because every week I'll break down real trades using my strategy. And I'll go in more in depth on these key concepts like fair value gaps, swing highs, swing lows, supply and demand. And I'll even talk about the 2 indicators that I use while I trade as well. That's all I got for today. Remember, trade smart, stay patient, stay disciplined, stay profitable. It's your boy Ron, and I'll see you at the top.